Hello everyone. Well, it's back to normal at the Bank of England. Bank of England Governor Carney yesterday ended his 6-month experiment with forward guidance and returned to a more normal style of policy making. Rather than making specific promises about what would trigger a reevaluation of policy, he tried to guide the markets as to how the bank will eventually unwind its ultra-easy monetary policy. This detailed explanation of the bank's reaction function was essentially returned to focusing on all the variables that influence inflation, which is what monetary policy used to be. But with the Monetary Policy Committee being much clearer now about how it would make its decisions and what kind of an end game it envisions for its policy. The market took Mr. Carney's statements as suggesting higher interest rates sooner than before, particularly his statements about the strength of the recovery, and pushed sterling and sterling interest rates up sharply. But Mr. Carney seemed to push back against this conclusion in interviews afterwards. I think there could be some profit-taking on sterling after yesterday's big rise. Longer term, this new system basically means a return to watching all the data every month, not just unemployment, and therefore makes it likely that sterling will become more volatile and stronger, in my view. The other big event yesterday was a comment by ECB Executive Board member Benoit Cœur, who said that the ECB is very seriously considering negative deposit rates. He'll speak again today, and the market will be waiting to see if he repeats or amplifies that statement. Because yesterday he also made some upbeat comments about the Eurozone recovery. If he focuses on the upbeat today and fails to elaborate on negative rates, Eurodollar could rebound somewhat. Also, the ECB publishes its monthly report today. The market will be looking to see what private sector inflation forecasts are to determine whether inflation expectations are still well anchored. Overnight, the Australian dollar fell precipitously after the unemployment rate rose faster than expected in January. It's now back to levels that actually haven't been seen since 2003, so the RBA must be sensitive to this problem. I still think the newfound enthusiasm for the Australian dollar is too sudden a change in view, and I remain bearish on the currency. Today, the Riksbank takes its turn on its rate decision. The market expects the bank to keep its benchmark rate unchanged and its rate path also unchanged. As a result, the focus will be on the press conference afterwards by the governor and also the bank's forecasts on inflation and growth. In the U.S., on the other hand, Fed Chair Janet Yellen's testimony for today was postponed indefinitely because of snow. Given that this week's heavy snowfall coincides with the survey week for the employment data, we're going to have another round of distorted figures this month that will leave the market and the Fed wondering about just what the underlying trends are. Also in the U.S., retail sales for January are forecast to be unchanged. That's compared with a 0.2% month-on-month rise in December. That slowdown could depress the dollar. Initial jobless claims for the week ended February 8th are forecast at 330,000 compared to 331,000 the previous week. That would leave the 4-week moving average really very little changed and probably wouldn't affect the markets. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.